Have you ever wondered how do you decide on whether a stock of a company is cheap or costly? Or stock of company A is cheap as compared to the stock of company B? There are other methods to ascertain the valuation of a stock, but the PE ratio is the most easiest and widely used ratio. As the name suggests, the PE ratio gives an indication of how much we are paying for the stock in relation to how much net profits the company is generating. So P stands for the price of the stock and E stands for earnings per share. To understand earnings per share, let the profit of a company be 10 lakhs and the number of shares be 2 lakhs. Then earnings per share in this case is 10 lakhs divided by 2 lakhs, that is 5. There is another way to look at P/E ratio. Consider that the company pays the entire annual profits to its shareholders. So the number of years it will take to recover the purchase cost, you can call it the payback period. For example, company A generates earnings per share of rupees 10 and trades at rupees 50. So the PE ratio is 5. This means an investor will be able to recover his original investment of rupees 50 in 5 years if every year the company distributes its entire profit. Low PE means shorter payback period and hence makes an attractive investment. So the next question is, can I buy all the stocks that are trading at low PEs? Ideally, this should be the case, but the answer is no, because more often than not, a low PE could also be due to factors like weak management quality, poor balance sheet, or that the market does not have faith in the company's business. Example, public sector banks. On the other hand, a high PE stock does not necessarily mean that it is expensive and is poised to crash. A high PE may also mean that the market is willing to pay a premium for superior business model, good management quality, and attractive growth potential. Example, Asian Paints. Let us take an example to understand PE ratio. There is a stock A which is trading at rupees 500 and has earnings per share of rupees 100. Another stock B which is trading at 50 and has earnings per share of rupees 5. Therefore, the PE ratio of stock A will be 5, whereas the PE ratio of stock B will be 10. So you might be wondering which stock is cheap between the two. Based on PE ratio, stock A is cheaper than stock B. Now we go to the next question, how do I know what is the right PE? So we consider an example where we have Hindustan Unilever from FMCG sector and Tata Steel from steel sector. Based on current trading price, Hindustan Unilever is available at a PE of 69, whereas Tata Steel is available at a PE of 4.3. So you might be wondering, why is there such a great difference between their PE? This is because sectors like FMCG, Pharma, and IT are considered blue chip, low risk, and hence get a higher PE. Whereas profits in steel are subject to wide fluctuation in steel price, hence considered risky and therefore command a low PE. Now you will ask, Hindustan Unilever and Jyoti Labs are from the same sector, that is the FMCG sector, then why the stark difference in their PE? So again, PE depends upon factors like quality of management, entry barriers, technological edge, and several other factors. So your next question will be, both HUL and Castrol are MNCs with good quality of management. Then why is there a great difference in their PE? So PE is directly correlated with future profit growth. In Castrol's case, its lubricant business has matured and is growing at a very low pace. Hence, despite being a MNC, it is trading at a huge discount to HUL. PE can also be used to get an idea about market valuation. The Nifty is currently trading at 1 year forward PE of 23 because market always looks at future growth potential. Since historically the Nifty PE has peaked at valuations above PE of 21, we can reasonably say that the Nifty is now fairly valued or slightly overvalued. Presented in the chart is the long-term trend in Nifty forward PE. What we see is that the average 1 year forward PE of Nifty has been approximately 15.5, while the mean plus one standard deviation PE is approximately 20. It is clear from the long-term trend in Nifty PE that when the Nifty PE crosses about 2021, probability of a correction increases. PE is the most popular metric in stock valuations because of its simplicity. However, it is not conclusive and an investor should consider other qualitative factors also while taking investment decisions.